Thanks for joining us on Digging for Value. I'm Allison Southwick. I'm joined by Taylor Muckerman and Joel South, energy analysts here at the Motley Fool. Today we're going to talk about Shell CEO's big regret, and we're also going to make some picks for rising natural gas prices. But first, to the headlines. Our top story over at the Wall Street Journal. The Wall Street Journal is a Pollyanna today, pointing out that amidst the drama surrounding the shutdown, we totally ignored the fact that gas prices are falling and could drop another 30 cents by December. Woohoo!
Cheers.
You excited? You guys sound so psyched.
I don't drive, but I'm excited for everybody else.
So Taylor, this sounds like good news for consumers. How should investors feel?
Well, I mean, look at this right now, and you're looking at the government shutdown saying it's going to affect $1.6 billion in overall spending. But here we're talking about $30 billion coming back to the consumer this way. So from an investor standpoint, I'm looking at maybe this hurting refiners with lower gas prices that crimps margins. Their crack spread, which is the price that they pay for the oil turned into refined products. So mid-continent refiners are really going to feel the pinch because the spread between WTI, which is the U.S. benchmark, and Brent, the international benchmark, have been kind of collapsing here a little bit. On top of that, now lower gas prices are really going to hurt them. Coastal refineries like Phillips 66 or Valero might not be hurt so much because they have access to ship off these lower priced petroleum products internationally. But if you look at a Holly Frontier or a CVR refining based more in the mid-con, they could be hurt a little bit more. So watch out for investors in those companies.
Now, in the article, the Royal Bank of Canada says that if gas stays at around $3.30 a gallon, that'll mean an extra $30 billion that consumers can spend elsewhere.
Yep.
So where do you think consumers are going to be spending that money?
Well, with all the handouts furloughed employees have been getting from the likes of Z-Burger and other companies in the D.C. area, hopefully they'll be spending it at restaurants once they get their back pay. And with this $30 billion, some retailers that have really been hurt, you look at some higher cost retailers like Nordstrom's showing some poor quarters over the recent past. So maybe this $30 billion is coming at the right time for the holiday season. All
right, for our next story, we're going over to Fuel Fix. A Texas regulator is predicting that daily oil production in Texas could reach 4 million barrels a day in 2020. As comparison, Saudi Arabia, the world's leader, produced 11.7 million barrels a day last year. So, in the article, the regulator goes on to say that what happened in our state over the last 5 to 6 years is nothing short of a technological miracle.
That's absolutely true. I mean,
is it absolutely true?
If you look at over history, Texas has always been one of those states that's been a big oil producer. But one of the biggest fields in that area was the Permian Basin. That was an aging field. A lot of people were selling off assets there. They thought as it matures, there's really not as much oil there as a lot of companies needed. So they were selling a lot of assets. Then one of the other big plays is the Eagle Ford, a nice play where there's a lot of oil content in the ground. If you look back in 2008, there was 300 barrels a day being drilled in that play. Basically non-existent. If you look at where they're at today, they're over 600,000 barrels a day. Looking into next year, they're going to be pushing that $1 million barrels a day mark. So that's really phenomenal. Mm-hmm. One play that everybody thought was done, selling assets. One play that really wasn't even on the radar of any oil and gas companies, besides a few that were that saw ahead and got some assets there. Really, that was a play that was non-existent. So this is really transformational for the state.
So for investors, how do you invest in Big Texas?
Well, there's a couple of different ways you can look at it. If you look at the Eagle Ford, one of the plays that I really like, the best player in this space with over 600,000 net acres is EOG Resources. They're really the dominant player there. They've put together some great numbers. Oil production has been soaring there, and they've been on the leading edge of getting a lot of frac material for them, frac material that they groom themselves. They basically have sand mines that they bring down and to start drilling a lot of their wells, and that really gives them a cost advantage. They also put in rail transportation to move a lot of their oil into higher market areas, so they've been really beneficial. Shareholders have loved them. They've been soaring, and the Eagle Ford is one of the biggest reasons there. Another company that I like for the Permian Basin would be Devon Energy. They're one of the biggest players there. What's happening really in that play is, yes, it was a mature play, but now people are moving into that newer technology where they're using horizontal drilling and really hitting new areas, new plays, and bringing a lot more oil on board. So Devon Energy would be the one there. And if you combine them both, ConocoPhillips has great position in both of them. They were one of the early players there, making a lot of money for shareholders, and they're looking for so much oil growth in the lower 48. And if you combine the Bakken, they're looking up to about 150 barrels of oil equivalent a day in those areas, which is just fantastic. So I would see those as 3 solid companies to play oil production in Texas.
Shed a little bit of light on this. We visited Core Labs down in Houston recently, and kind of as a decorative feature in their floor tile, they have shale core samples, kind of as highlighting some of their tiles. And they were just given these shale samples back in the day when companies were drilling in these deposits, but just kind of cast them off to the side because they didn't really understand the true benefit that they could see if they decided to tap into these reserves. Now that it's finally here, those core samples are worth a little bit more than a floor sample.
Right. All right, now we're going to go to Bloomberg. Ethane's Tumble seen boosting profits at Dow and Westlake. I love the opener to this article, so I'm just going to read it.
Sure.
If you want to make a chemical company boss smile, and who doesn't, these days, here's the word to use, ethane. So, Taylor, what's behind the smile?
Well, for a little while now, we've seen low ethane prices, which is a predominant feedstock in a lot of the petrochemical industry. If you combine this with propane, the products that they're cracked into, ethylene and polypropylene, account for about 75% of all chemicals, plastics, and synthetic fibers. So a lot of people thought that maybe the price was going to reach a basement, but apparently not. Ethane prices is predicted to continue to drop a little bit, and because of that, margins are expected to widen even further than people expected at companies like Dow Chemical, LyondellBasell, and Westlake, and all 3 of those competitors are planning huge capital expenditures in the Gulf because of that.
Yeah, now Bloomberg mentions, they did mention Dow and Westlake as companies that are going to benefit. Are there any others that you see this is a huge opportunity for?
I certainly do. The midstream in the United States sees this as a huge boon. We talked to Steve Kane, the Chief Operating Officer at Kinder Morgan. He talked about propane and ethylene exports being a big business here. Because we do have such a surplus, the prices are going down. So now people are building pipelines to the Gulf Coast and the East Coast to distribute that around the globe. Because we have such an advantage, countries are using naphtha, which is an oil-based substitute for ethane. So if they can tap into our reserves here, Sunoco Logistics is a big player in that, building pipelines with Mark West to the East Coast and shipping ethane out to Europe. And they're also providing some transportation down to the Gulf Coast, along with El Paso Pipeline, which is a big player in the Kinder Morgan family. So all of those pipeline product companies I see really receiving a big investing boost from this.
All right, now it's time for our final headlines. Over at the Financial Times, they had a little heart-to-heart with Royal Dutch Shell CEO Peter Voser. Voser is going to step down as CEO in 3 months, so he had a little bit of a nostalgic look back and admitted that his biggest regret, or not his biggest regret, but one of his biggest regrets was that the $24 billion bet the company made in U.S. shale, which has not paid off. So Joel, what can you tell me about this bet?
Yeah, definitely. This is kind of hard because as an big integrated oil and gas company, you need to go and find new reserves to replace what you're already drilling. And Shell has really been on the cutting edge doing that. Not only did they have a big position in the United States, unconventional plays, they also went to offshore Alaska, tried drilling there, it didn't work out. The rig there didn't really hold up to the conditions. They're also building a very large natural liquid or LNG floating facility, which is costing multi-billion dollars. They're really trying to experiment on that as well. So this is something that they've always done. Obviously, $24 billion hurts, especially if you're looking at natural gas prices, what they did. And then also they're going back and putting up some of their Eagle Ford excellent oil assets up for sale because they just can't, they don't see it as part of their core business anymore.
So do you see the bet, though, as paying off eventually?
For Shell, I don't think so. I think they're going to slowly start pulling back. You know, when they went in and bought, just like ExxonMobil, when they bought XTO Energy for over $40 billion, people were expecting natural gas prices to remain high. Once that dropped, there really isn't a whole lot of money for them to be made. And then one of the other big things, a lot of their oil plays, they need that scale. They had 106,000 acres when I mentioned that Eagle Ford assets that they're selling. 106,000 acres doesn't do it for big oil. They need bigger projects. So if the scale is not there, they're better off to sell, move offshore, or go into some other foreign countries and try to get oil production there. So I don't really see unconventional in Shell's future. However, the bigger oil plays that are oil companies like ExxonMobil and Chevron that already have great positions here, they're here for the long term. Exxon will make their money. Eventually, natural gas prices will start creeping up. They're in the play for the long term. I don't see that for Shell.
So is this a Shell problem or a shale problem?
I think it's a little bit of both.
Clever.
A little bit of both. Very clever.
Pun intended.
In this case, it might be a shale problem because the natural gas prices are really hurting all the companies.
All right. Well, that covers it for the headlines, unless you had something else to
Oh
add
no,
on
I just
that.
think this is a company with a new CEO about to come on board, so maybe they'll give him a clean slate and maybe set investors up for a nice run once he steps up.
So it sounds like you're kind of optimistic on Shell going forward.
I could be. They've got some good assets outside of the United States, so we'll see.
Wow, I could be optimistic about a lot of things, huh? So, all right, now that's it for the headlines. Now we're going to play a little game that we're going to call Say When. But instead of looking at a stock price, we're going to look at natural gas. I am going to raise the price of natural gas, and you're going to tell me different companies that you like at that price. So, Joel, you are going to tell me about natural gas companies that you like. And now the price of gas right now is at $3.70 per 1,000 cubic feet. Who do you like at that price?
At that price, I'm going to go with a company like Chesapeake. What I really like about them, they are a natural gas company still. They still produce a lot of natural gas. However, you look at their capital expenditures, they're moving all towards liquids, oil specifically, and they're starting to turn around a lot of the issues that they had. They're funding their balance sheet, which was the problem in the past. Their oil plays are starting to pay off, cutting expenses. So what management's done is really turn them around. They're going to be able to fund a lot of their operations from cash flow, which is a huge mark for them. It's really a gold star that management's doing for them. So by doing that, they can outlast the low natural gas prices. If they keep moving towards liquids and have that natural gas in their back pocket as prices creep up, there could be a great buy. Even if they stay low for a long time, their oil production is really helping them out, and they're still a good investment right now.
All right, so if I raise the price to $4.50, who do you like at that price?
A lot more companies. If prices were to be sustained around $4.50, I would look at a couple of the low-cost natural gas producers, the people that are still in the business of drilling for dry and liquid natural gas. And first off would be Ultra Petroleum. I really like what they're doing. They have an all-in cost of around $2.22. So obviously if you extrapolate that to the $4.50, they can make a lot of profit. They have great assets in Wyoming where they're actually drilling wells over there cheaper than they are in the Marcellus, which right now is one of the cheapest plays in North America. They also have a great position in the Marcellus that they're finally starting to tackle. As that progresses, you'll see their efficiencies kick in and their costs drop. And at $4.50, they can really do real well. Cabot Oil and Gas is in the same thing. 3,000 more drilling locations in the Marcellus. They're also a low-cost producer, and at $4.50, their margins would soar, production would soar, and investors would really be benefiting from that.
Yeah.
All right, the last one is going to be $5.
$5, this is an interesting play. With $5 natural gas, I think Sandridge Energy will finally recoup what they've been losing over the last few years. And the reason what they've been doing is trying to do what Chesapeake's doing, moving into liquids. However, they sold their Permian Basin, which is assets, which is more liquid or oil-based, and they're basically having the future of their company set in the Mississippian Lime. However, the Mississippian Lime's a lot more natural gas than they originally thought, so they're slowly moving towards that liquids phase. But at $5, natural gas would be extremely profitable, and better yet, what they could do is sell the company for almost double what it's trading for right now, just for those assets if natural gas prices stayed at that level. So $5 natural gas, Sandridge Energy would be a steal at that price.
All right, well, you're all done now, so you can take a breath, have a glass of water, because now it's your turn.
Okay, fine.
You get the same prices, but I'm going to give you coal.
Okay.
All right, so now price, who do you like at $3.70 per 1,000 cubic feet?
Anybody in the Powder River Basin, it basically moves from west to east when you talk about price of coal in the United States. You're talking about Colorado mainly here, and a big company that's producing there is Peabody Energy. It's the largest privately held coal company in the United States. They also have assets in Australia, so they're more diversified than a lot of their peers. And because so much production is coming from the Powder River Basin, which is competitive with natural gas, when it's priced in the low $3 range, they're already competitive now and have been for a little bit. And then you look at Cloud Peak Energy, which is solely reliant on the Powder River Basin. So those two companies right now, I would be a buyer on, especially with Peabody's export capabilities.
All right, what if we go to $4.50?
Well, then we start to move a little bit further east towards the Mississippi, and you get to the Illinois Basin. This is a region where it's starting to become competitive with natural gas right now, so at $4.50, definitely buying into this region. You look at Alliance Resource Partners, which sources about 80% of its revenue from this basin, and they just had a record first half. So I look at prices to continue to creep up. This company is going to continue to provide their investors with distribution raises, which they've done now for 21 consecutive quarters. And then you look at a company company. Also, that you're talking about rail here, which or CSX gets a lot of its coal that it transports to the East Coast from the Illinois Basin. So if utilities along the eastern seaboard start to switch back to Illinois Basin coal, which you have seen a company like Southern Co. do pretty heavily, and they're actually talking about using 5 times more Illinois Basin coal over the next few years in their facilities now that they've started to implement scrubber technology. So Illinois Basin at $4.50 and a lot of its producers there.
All right, final price, $5.
Well, then you get to the central Appalachian region, which has just been decimated by natural gas, and I think it could still be even at the $5 range, but here I'd start to look at Alpha Natural Resources. Around 50% of their revenue comes from the eastern coal, so they could finally start to see a little bit of a safety net here. And then at James River Coal, I don't think $5 even bails them out. They've been shutting down plants and laying off employees almost on a monthly basis, so I guess if you had to reach for a $5 level, Alpha Natural would be the company I'd go for there.
And great deals if natural gas prices reach $5.
Yeah,
coal
huge.
companies have been down 95% since natural gas prices dropped, so that would be such a boon for that industry. There's tons of deals there. It's just, can they outlast it? Do they have the balance sheet to do it?
Yeah.
Some of the big guys, yeah, but that would be nice, $5 natural gas.
If you're contrarian, go ahead and buy in now and place your bets.
And then keep your fingers
Yeah, exactly.
crossed, pretty much. All right. Well, that's going to cover it for today. If you're looking for more energy and materials analysis, we've got you taken care of at Fool.com. And you can also follow us on Twitter at TMFEnergy. For Taylor Muckerman and Joel South, I'm Allison Southwick. Thanks for watching.